Are Chinese stocks too cheap to miss now? Famous Chinese analyst Hong Hao has just published a research arguing that might be the case, and that there's a trade for the brave, especially given how US inflation might have peaked. Welcome to Money Seafood, everybody. Hong Hao, an outspoken hedge fund analyst who has successfully identified many market trends and recently got into trouble for correctly predicting the route of China's stock market, has just published a new report in which he argues that stocks in Hong Kong has been truly, madly, and deeply oversold. Hong has three basic theses. Hong Kong is in a hot mess, but stocks are simply too cheap. Second, clues from China show that inflation has peaked and a recession is coming. Third, the US market is so distorted, the Chinese market may be more informative at this point. So, point number one, Hong said that the China-US new Cold War on tech and auditing access have dealt a blow to Hong Kong. But the territory's market index, the Hang Seng, is now at its lowest in more than a decade, and is at a similar level of 1997 during the financial crisis. So Hong, despite his recent record of being harsh on China, has kind of turned positive on Chinese stocks now. He said, at these levels, a lot of the bad news must have already been in the price. Point number two, clues from China show that US inflation has peaked. Hong basically said that demand will soon fall because US demand for Chinese goods is looking to wane. He got the idea by looking at the Chinese 10-year yield, which indirectly reflects US imports and US trade deficit against China. Historically, Chinese 10-year yield leads the US demand by up to 18 months. So the chart shows that the US demand will fall in the coming months. Another clue is China's Producer Price Index, or PPI, which measures inflation from the viewpoint of China's producers. China's PPI has already been falling. However, US CPI, or the Consumer Price Index, which measures inflation from consumers' perspective, have gone on to the complete opposite direction for far too long, the furthest apart in 2 decades. As a result, Hong believes that US inflation has peaked. His third point is really to justify the second point. The US market this year has been so tricky that many of the economic indicators people normally rely on have been badly jumbled. By contrast, China's becomes one of the few remaining markets which functioning normally, which can provide us with better clues to understand the global economy. He said, reading clues from US bonds that have behaved abnormally this year may not give a plausible diagnosis of the US as well as the global market. Instead, reading from a normal functioning market such as China can be more helpful. To elaborate on this, he took the hedging relationship between stocks and bonds as an example. Note that both bonds and stocks plunged in the US this year, as well as many developed countries. The China market may be one of the few remaining markets where hedging relationship between stocks and bonds continue to work. So yeah, that's about wraps it up for today's video. Hopefully you guys learned something from this. Anyway, until next time, Money Seafood signing out.